It all begins in the early 1980s, in the chaotic and high-energy trading rooms of Chicago of that era, with the sprouting of one of the most legendary bets in the financial world. The lead roles in this story belong to Richard Dennis, known as the commodities king of the markets, and his mathematical genius partner, William Eckhart. Richard Dennis argued that being a good trader was not an innate talent, but a skill that could be acquired entirely through systematic training and discipline. His partner Eckhart vehemently opposed this, claiming that trading success required a genetic predisposition, an instinct, and mathematical intelligence. This deep divergence of opinion gave birth to the most famous experiment in financial history, the turtle trader's experiment. While visiting a turtle farm in Singapore, Dennis was so impressed by the systematic production process, he saw that he settled the debate by saying, "We can raise successful traders just like they raised turtles in Singapore." By placing ads in newspapers, they gathered thousands of applications and invited a group of selected young people, who had absolutely nothing to do with finance, to Chicago. The system taught to these young people, which made them millionaires, is a trend-following system based entirely on the pure power of mechanical and technical analysis, known today as turtle trading. At the heart of this system lies Richard Dennis's revolutionary and equally simple approach to technical analysis. For Dennis, technical analysis was never an attempt to gaze into a crystal ball and predict the future. On the contrary, he saw charts as a reflection of collective human psychology and the supply-demand balance in the market. According to Dennis, technical analysis is not a forecasting tool, but a reaction tool. The market does not tell you what it should do. It tells you what it is doing. Your job is not to put up resistance to the price or harbor prejudice, but to attach yourself to the current movement in the most efficient way possible. At this point, when we deeply examine the technical mechanisms of the turtle trading system, we encounter two main strategies. The first system, the short-term system, is built on a 20-day breakout. If the price breaks the highest level of the last 20 trading days upwards, it is a buy signal. If it breaks the lowest level downwards, it is a sell signal. However, Dennis added a very critical filter here. If the previous 20-day signal resulted in a successful trade, meaning a profit, the system considers the next signal risky and skips it. This is an ingenious filter designed to prevent the market from setting traps in overbought or oversold zones. The second system is the more conservative and long-term 55-day breakout system. No filter is applied here. The moment a 55-day high or low is seen, a position is entered regardless of the outcome of the previous trade. In Dennis's philosophy, the purpose of these two systems is not to miss those massive trends that might form in the market. This approach, also known in technical analysis as Donchian channels, considers the price exceeding its own history as the greatest show of strength. However, the true genius of the system lies not only in when to enter, but in how much to enter with. This is where the concept of N, known today as ATR, average true range, comes into play. Shaped by William Eckhart's mathematical contribution, this structure places volatility at the center of technical analysis. For Dennis, rather than the price of a stock or commodity, how volatile that asset is matters more. The N value tells us the market's breathing room by taking the volatility average of the last 20 days. A turtle trader sizes every position according to this N value. That is, smaller positions are opened in a highly volatile market, while larger positions are opened in a low volatility market. This ensures that the risk always remains mathematically constant. The pyramiding technique applied after entering a position is proof of how aggressive yet controlled Richard Dennis's understanding of technical analysis was. Dennis used to say, "If you are right, you should be more right." After a position is opened, every time the price advances by 0.5 N in your direction, meaning a certain profit has formed relative to volatility, a new unit is added to the position. These additions can go up to 4 units in total. This strategy allows you to use your capital with maximum efficiency only when the trend is truly strong. However, while reaching this size, risk management is never abandoned. In the turtle system, the risk taken for each trade can never exceed 2% of the total capital. The stop-loss point is placed 2N below the entry price. If the price moves contrary to your expectation and causes a loss equal to twice the volatility, your analysis is considered flawed and the position is exited emotionlessly. If the position has been enlarged through the pyramid method, the stop level of all units is pulled up as new additions are made. Thus, even if the profit is not realized, the amount to be lost in a potential reversal is minimized. The exit strategy from a position is the part of turtle trading that requires the most discipline. Many traders get excited the moment they see profit and sell early out of the fear of, what if it reverses? Richard Dennis set very clear rules to eliminate this human weakness. If you are in a long position in the first system, you continue to sit on the profit until the price drops to the lowest level of the last 10 days. In the second system, this period is 20 days. This sometimes means giving back 20% of a 50% profit, but according to Dennis, big money is made by staying in the trend until its very last drop. In technical analysis, this is the most primitive and effective form of the trailing stop logic. When the exit point is reached, one does not wait for the stop to blow. The trade is closed the moment the price touches that level. This strict discipline disables the trader's personal views, hopes, and fears about the market. There are no formations, indicators, or complex oscillators in Dennis's approach to technical analysis. He used to say, complex analysis doesn't make a trader smart, it just makes them indecisive. In his world, where the RSI is, or whether a head and shoulders formation has formed, are secondary issues. What matters is the price. The price breaking its 20 or 55-day high represents the current consensus of all participants in the market. Dennis saw technical analysis as a game of statistics. He knew that getting stopped out frequently and losing money in a sideways market for a long time were natural parts of this game. However, he had mathematically proven that when he caught a trend, that trend would bring back all the losses manifold. Therefore, technical analysis for him was not a prediction, but expectation management. It should be particularly noted that Dennis's biggest difference was using volatility as a measure of risk. While most people see support and resistance levels as random lines, Dennis would stretch these levels according to the market's volatility, namely the N value. Instead of trying to figure out whether a breakout was real or not, he would calculate how much risk to participate in that breakout with. This took technical analysis from a static picture and turned it into a dynamic process. According to Dennis, entry signals are only 10% of the job. True success lies in the remaining 90%, which is position sizing, risk management, and exit discipline. The reason why one of two traders standing in front of the same chart becomes a millionaire while the other goes bankrupt is not the indicators they use, but their loyalty to this mathematical architecture. The truth that emerged as a result of this experiment by Richard Dennis and William Eckhart was this: trading is a teachable art, but only for those who follow the rules to the letter. Those among the turtles who became very successful were the ones who accepted Dennis's technical analysis and risk management rules as a dogma. Those who failed were the ones who tried to add their own genius to the system, bending the rules by saying, the market has gone up too much, it will turn now. Dennis's technical analysis completely excludes ego. It says, you cannot be smarter than the market, you can only follow the market. In this philosophy, structures like cup and handle or Elliott waves can help in determining direction, but can never impose a target price. By saying the past can show the direction, but can never limit the distance, Dennis points out the biggest mistake of technical analysis, the mistake of setting targets. No one knows how far a trend will go, and according to Dennis, trying to know is a futile effort. Trend following is the purest and most ruthless form of technical analysis. It allows you to obtain very high total profits despite having a very low success rate. Dennis's turtle trading system teaches us that technical analysis is actually a test of character. When the price breaks the 20-day high, everything looks very easy. But being able to stay in that position for months, watching some of the profit melt away, and staying loyal to the stop level requires immense psychological strength. Dennis used technical analysis as a tool to alleviate this psychological burden. He made the rules so clear and mechanical that he eliminated that heavy stress in the trader's decision-making process. Finally, we must understand that Richard Dennis's success did not come merely from drawing the right lines. His success came from finding a mathematical order within the randomness of the market and applying this order without ever breaking it. He took technical analysis out of being a guessing game and transformed it into a discipline of probability and risk management. The quote, "Follow what the price is doing, never think about what it should do," is the summary of his entire trading life. Today, at the foundation of many strategies used by algorithms and artificial intelligence in modern markets, lies this trend-following logic that Dennis built with simple but unshakable rules back in those years. The Turtles experiment proved not only that traders can be trained, but also how great a power a disciplined mind and the right philosophy of technical analysis hold in the financial world. This system continues to remind us every day that the way to survive and grow in the markets is not through complex formulas, but through unshakable loyalty to simple rules. This long and detailed narrative serves as a guide for you to grasp Richard Dennis's legacy and the technical depth of the turtle trading system. Remember that technical analysis is not just reading charts, it is the ability to understand the soul of the market and move in harmony with that soul. Dennis's path is the path of patience, mathematics, and discipline. When you integrate these rules into your own trading life, instead of getting lost in the noise of the market, it will be inevitable for you to achieve long-term success like turtles gliding over those massive trends. Markets may change, products may change, but human psychology and the reactions price gives to this psychology have never changed since Richard Dennis's era, and probably never will. That is why the principles of turtle trading will continue to remain on the brightest pages of financial history as timeless technical analysis classics.
Thank you for watching our video. In the next episode, we will examine the journey of another legendary trader. Don't forget to subscribe and turn on notifications. For more content and strategies, you can join our Telegram channel. The link is in the description.